All right, everybody. We're back, and this is the final unit of the macro course. And what we're looking at is the balance of payments. So, what we mean by balance of payments is the money and capital flows between the U.S. and the rest of the world. Or, if you're going for a different country, it'll be whatever your home base country is and the rest of the world. Any inflow is a credit to your balance of payments, and any outflow is a debit. So if money is coming in, that's inflow, that's credit. If money is going out, that's outflow, that's a debit. And the balance of payments is divided into two different accounts: the current account and the capital/financial account. Sometimes you'll see the capital financial account under a few different names, and we'll discuss that when we get to it. So, as a sort of introduction to this, if you look at this balance of payment account, this example here, you see all the credits on the left side, all the debits on the right hand side, and you'll notice that it is split up between the current and capital accounts. The current is on the top grouping, the capital is on the bottom. Now, um, my numbers here are a little off. It's everything in the current account. So 1, 2, 3, 4, 8, 9, 10, and 11. Those all do not create liabilities. Those are sort of uses of money, if you will. So things that are purchased and it's done. So that is the current account. Uh, 5, 6, 7, 12, 13, 14, those do create liabilities. They create a source or purchase a source of revenue or loss for whoever's purchasing them. That is the capital financial account. And in the end, all of your current accounts should equal your financial accounts. So you add them together, you should get zero. If there's any imbalance, it's going to be settled by the official reserve account, which isn't really covered too much on the AP test. But basically, it is what the government uses to settle up any differences between our currency or the home country's currency and whoever they're trading with. So going a little bit more in depth with the current account. The current account is, think, one and done payments. So the easiest to think of is exports. Net exports are going to be your biggest base of the current account. So this is export of goods and services. That is credit. So if you're exporting, it's a credit. If you're importing goods and services, that's a debit. Because once again, think which way the money is going. If the money's coming in, it's a credit. If the money's going out, it's a debit. Net foreign income. So income earned by U.S. owned foreign assets. So this is income paid to people who are in your home country from an asset in another country. So interest payments on U.S. owned Brazilian bonds. The interest payment comes in. That is net foreign income. That would be a credit. Net interest on German-owned U.S. Treasury bonds, that would be a debit, since the money would be flowing from the U.S. to Germany. Um, Now notice this is the income earned, not the bond itself. So the bond itself is actually going to be in the capital account. The interest payments themselves, that is income. Net transfers are also going to be under the current account, and this is literally just sending money abroad. So foreign aid, that's a debit. That's money getting sent abroad. Mexican migrant workers sending money to the family in Mexico, that would be a net transfer. If you have a job in another country and you send money home, that is going to be a credit to wherever you're sending the money to. The capital financial account's a little bit trickier. Here you're thinking factors of production and financial assets. It creates an ongoing relationship is sort of the easy way to think about it. So it includes the purchase of both real and financial assets. So if you think bonds and stocks and things like that, that counts. But so do factories. So direct investment in the U.S. is a credit to the capital account. So Toyota, a Japanese company, builds a factory in San Antonio. That is direct investment in the U.S. That is a credit to the U.S. capital account. If a U.S.-based company like Intel builds a factory in San Jose, Costa Rica, that is a debit to our capital account. Now, capital account is the more current way of phrasing this, but Sometimes you'll see older materials talk about the financial account, or sometimes you'll actually see this account broken up into two separate things, with capital being sort of the physical capital and the financial being the purely financial assets. For the AP test, you don't have to worry about that. It will just use capital account. Um, so those financial assets that you'll sometimes see phrased under just the financial account, that would be the stocks and bonds. So Warren Buffett buys stock in China. The money is flowing towards China because Warren Buffett is buying stocks there. So that would be a credit to China's capital account. Meanwhile, if another country uses their sovereign wealth fund to purchase a large stake in the NASDAQ, which is a US based fund, that is a credit to the US's capital account. So the causes of these capital flows, like what causes people to save their money, put their money in financial assets or physical assets in other countries, well, that has to do with different rates of return on investment. Savings actually flows towards higher returns. So if you have a higher interest rate, you're going to have more people saving money in that country because it's attracting foreign investors. So you use the loanable funds market to model this flow of capital. So if you think about this, and once again, this is just the financial assets, not the physical assets. If you look at this example that you see here, you have the USA on the left, China on the right. Here you have initially a lower interest rate in the US. Meanwhile, you have a higher interest rate in China. So where do the funds want to go? They want to go to China. So you'll notice less saving in the US. So supply of loanable funds decreases. Meanwhile, the supply of loanable funds in China increases, representing the flow from the US to China. So that is how you model the financial account using the loanable funds market. Now, the other determinants of capital flows, differences in economic growth rates. If you have a rapidly growing economy, people will want to invest there, so they will put their money in that economy. Differences in savings rates in general, a high government budget deficit reduces national savings. This leads to capital inflows because of the higher interest rates. So foreign investors want those higher interest rates, so they put the money into your economy. And it is important to remember that the capital does move in both directions. This is a two-way thing. People are always going to be creditors and debtors at the exact same time. And it can be for any number of reasons. The stock market can be doing well, the country can be safe or unsafe, and really anything. And if that ever shows up in the AP test, it will be kind of obviously stated. And that's it for capital flows.